Zihao Xu, welcome on to Searching for Mana.
Thank you very much for having me. Pleasure to be here.
Fuller introduction. Z, who's a principal with Octopus Ventures and has been working with them since around 2016, has a mandate to try and look for the future of finance through entrepreneurs, founders, companies in their embryonic phase. And of course, as a venture capitalist, then provide the capital and foundations to help them scale. Z went to Oxford, studied economics and management. That was around 2010. Went to Roland Berger, who are a top strategic consulting firm, spent 6 or so years there, and then loops back to Octopus. So Z's on the show amongst many other VC candidates who line up every week to be on it, because we've had a couple of conversations, and Z's a very charismatic guy and does a lot of cool stuff in and out of work, which we're going to go into. I gave a brief intro, but perhaps if you could explain to the audience who Octopus Ventures are and what your role within that is.
Yeah, of course. So Octopus is, actually, if you Google us, it's a little bit confusing. So I'll try to peel back the onion layer by layer for your listeners. Octopus Group is a sort of large asset manager looking after just shy of £10 billion, I think, at the moment, across various different asset classes, small cap, sort of public investments and private equity. At one point, we owned, I think, one of the largest sort of solar assets within the UK, and Octopus Energy is sort of our retail energy arm that lots of people would have heard of. Octopus kind of exists to help transform markets, kind of from a customer experience and a sort of customer perspective, right? Lots of industries within financial services or within energy, which are the two big ones that Octopus focuses on, tend to not have great customer experience. And so when Simon and Chris set up Octopus Group, that's for that. Now, about 13 years ago, Octopus Group acquired what was called Catalyst at the time, which is an angel syndicate, an angel network put together by the founder of that, and then it became Octopus Ventures. So Alex McPherson and some of his colleagues put together Octopus Ventures, and it sort of started in earnest in 2007, and we are the sort of early stage venture capital arm of Octopus Group, as it were. That has grown from, I think it was around 30 million under management at the time, so I think the latest number is 1.3 billion sterling, which makes us a pretty sizable fund when it comes to the early stage environment, certainly here in the UK and Europe. Comparing it to the West Coast is a different story. And then within Octopus Ventures, then we have a number of what we call pods. So these are sort of origination teams that are focused on different areas. So if you think of Octopus Ventures, the mission of the entire team is to back pioneering entrepreneurs who are looking to change the world. Well, actually, that can come from a number of different axes. And right now we have, the future of money, which is the team that sort of I kind of look after on a day-to-day basis. We have the future of health, which is pretty self-explanatory. Deep tech, and they're kind of the clever guys and girls who look at, rockets and drones and quantum computing and all this sort of stuff. And we've just spun up a consumer pod as well. So this is a team looking at sort of primarily consumer-facing businesses, whether that's sort of brands or future of work and all that sort of stuff as well. So out of the 4 pods, future of money, we focus, as you would imagine, on fintech businesses primarily. We can go into in a bit more detail how we think about that. But there's a team of sort of 6 or so of us at the moment who spend all our time on that.
In terms of, just to finish understanding the scale of Octopus in the venture part with the separate pods, which we'll spend most of the show talking about. Thanks for the context of the overall group. How would we understand how that ranks versus other European funds? You guys, let's forget America, but within Europe, you're significant. You're a significant player with that type of overall funding out there.
Yeah, so if you look at the last few years, we tend to invest about 100 million per annum across the pods into European and actually UK focused seed, Series A, and a bit of Series B. Which, in terms of sort of size of deployment is, as you say, pretty significant. We're one of the largest and most active funds in Europe looking at early stage technology.
Octopus looks for unusually talented entrepreneurs. Define what constitutes unusual talent.
Happy to go into it. So there are lots of kinds of entrepreneurs out there who build lots of amazing businesses. And some of those businesses are sort of appropriate for our fund and our investments. And some of these are wonderful businesses that aren't quite sort of made for the kind of investments that we're looking for. And when we talk about sort of unusually talented, it bakes in a whole bunch of different things, right? Firstly, it talks about sort of folks who are building businesses that may be unusual, right? Any business that goes from naught to several hundred million within the course of a few years is highly unusual. And we focus on those. There are lots of businesses that will do very well for the founders and for the team, but it won't be appropriate for venture capital as an asset class. So that's sort of one piece of it. And I guess the other piece of it, we can go into sort of how we look at founders more generally, right? Because this is a massive topic in and of itself. And to give the context around this, in order to get really big, you're often looking for a set of data points that talk about how much money can you make? Can you make margin on that money? Can you take a market over? But when you're so early, as we are, in terms of when we're looking at these businesses, you have to rely so much on the team and the founders, right? So when it comes to unusual talent, that is a sort of shorthand for a number of things that I think about, or that we think about. It's a combination, I would say, probably 4 things. You're looking at product focus, you're looking at domain expertise, you're looking at ability to sell, and you're looking at ability to execute. Within a founding team, you need all of those things. Now, they'll mean different things to different people in different funds. And if you'd like, I'm happy to sort of go into how we think about it. But those 4 aspects are really key to any successful sort of high growth startup. And actually, we want to see the seeds of those characteristics, very early on.
And what's really insightful here is how you're capturing that so early on, and those 4 principles that you're looking at. So if we break those down, you mentioned product as the first one, which for me, early on, is almost the hardest one to judge, perhaps, right? It's easier to judge a founder, potentially, because we can go into that. You can look at previous success that founder has had. You can look at the traits that they've exhibited through education, the type of institute they went to, the desk that they were on, etc. And then in terms of the market, again, this really depends if you're in a future market or if you're in a old market that's being disrupted. So again, I think you can run analytics on that. But product early on, that's so hard. Let's start with that one. How are you cutting that up?
As you say, it's really hard, right? And often we invest before a product's even built. So how do you sort of think about product in that sense? I think for us, product and kind of product vision, right, which is probably closer to what we mean, or what I mean, is around kind of your ability to really understand the customer problem, to a level of depth that is kind of unreasonable for most people. And 2, understand the kind of environment within which you're able to try to solve that problem, right? And at the early stages, the evidence we'll look for is, and this will vary vastly between B2B and B2C and all kinds of different sectors. But let's say we're talking about B2B for a second, someone that has been kind of in the trenches with the kind of individuals they might be looking to sell to, right? So do you understand kind of the nitty gritty problems that you're trying to solve for someone? It's not just about, let's say, it's not just about data and analytics. It's about sort of, the person who's trying to buy the data analytics software or the person who's trying to sell to. What are they trying to solve with that analytics? What do their day-to-day look like? Or, what does her KPI look like for how her team is judged and remunerated at the end of the year? What do almost the office politics look like of what needs to be signed off in order for things to get bought? To really understand in detail the scope of that customer problem. And secondly, to understand, what are the resources available to put a solution together, right? The best proof of that is, of course, the best preventing of this is a multi-billion IPO on the public markets. But before you get there, you kind of keep winding that back, right? So actually before the IPO, you kind of got, great quarter-on-quarter results. Before you got great quarter-on-quarter results, you're looking at sort of a business that looks like it can be profitable with, the scaling really well. Before you've got that, you want it all the way back to, do you have a product that customers absolutely love? Are they sort of ripping it out of your hands? One test is actually if you threaten to remove it, are your customers going to squeal? And if you go back before that, before they even built that product, it's a case of, do we believe that this entrepreneur has the ability to think through this problem and solve this problem in a way that is meaningful?
So if we go back to that elementary point where you're thinking through now the founder's makeup, could you talk us through what you're looking for there, please?
Yeah. So pre-product. So one piece is that the vision of the product, right, and understanding of the problem. And actually, if I talk about the founder, the 4 things I mentioned are characteristics of the founding team that we like to look for. So if I go through the second piece, which is around domain expertise, right? Does this individual or this set of individuals understand the incentives within this industry that they're trying to change well enough to be able to find a route through it, right? Lots of the founders that you would have spoken to on this podcast, they don't necessarily succeed straight, one shot, with the exact strategy. In fact, I think someone did a study, 93% of founders have to change their strategy in order to succeed, or 93% of successful founders, I think, had to change their strategy midway through. And in order to be able to do that well, you really have to have a nuts and bolts understanding of what you're trying to do and the ecosystem that you're trying to change. So that's kind of how we think about domain expertise. And actually, this is a really hard one for someone in my position, as someone who's looking to assess the domain expertise of the founders, right? Because firstly, I'm coming from a perspective of not having it myself. So trying to verify something where I don't know the answer can be quite difficult. And secondly, there's this there's a difference between really being an expert and sounding like an expert, right? Charlie Munger, who's Warren Buffett's, sort of long-term business partner, he has this amazing anecdote, I think it's been proved apocryphal, about Max Planck, right? So the theoretical physicist driving around or being driven around by his chauffeur, delivering lectures on theoretical physics. And after, a few dozen of these, the chauffeur turns around and says, look, I'm kind of bored of just like waiting here every time while you're doing this lecture. Like, can I give the lecture? Do you mind if I do it? and Max Planck said, yeah, of course, crack on. So he gets on stage, delivers a lecture with all of the sort of anecdotes and, charisma that Max Planck is able to do it with. And then someone in the audience asks a very simple question. And all of a sudden he's stumped. So this difference between sort of Planck knowledge and chauffeur knowledge is pretty critical. And that's, of course, simplifying it massively. But how do we, as investors, try to distill Planck knowledge when we haven't got it ourselves, right? So that's a really interesting problem that we're trying to solve.
So let's take an example of a company that you have decided to invest in, whichever you want to choose, which was very much, it's quite early on in you're thinking that the founding team exhibit everything that you look for. And then how do you support them post that investment that you make into the team?
Yeah, lots of different ways, and it varies a lot depending on the kind of company, depending on who our co-investors are. We play a very different role, I think, sort of on the board of these businesses, depending on the context, right? So there is a business that we invested into around 18 months ago called Mosaic Smart Data, which is a capital markets business. They sell sort of data analytics software into various players within the fixed income space. And if I look at sort of the composition, the makeup of the folks around the table of that business, we co-led the round with our good friends at Octopus Ventures, who have this amazing combination of being sort of really early stage experts, but also coming from that sort of banking background. The other folks around that table are JP Morgan, who's in residence program that Mosaic came through. So, talk about kind of domain experience around the board table. We've got some really senior folks from JP who get to input into that business. And, the team brought on a non-exec who's the CTO of PIMCO, right, one of the sort of largest buy-side firms in the world. And in that context, what we bring to the table is quite different, right? Because if you want links to anyone within the financial services world, we're not the folks to go to for that. However, we bring the sort of early stage company building experience here, right? How do you think about positioning a sales team before you have product market fit? How do you think about what product marketing might look like, within a certain context? So, bringing sort of that element of how to scale businesses, whatever domain they might be in, and putting that within the context of the expertise that others bring around the table is super important. Outside of sort of our board contributions and my ability to link resources from the rest of Octopus into the business, we have an amazing talent function led by Laura Welmy, who came over from the United States to join us. Between her, Georgiana, and Sarah Ruth, who sits out in New York, they really help our companies, sort of think about how to build a talent function, which I know is something, really close to your heart, Lloyd, at various stages of growth. And they get really stuck into helping to build, culture documents, how to think about diversity, actually, generating leads for hiring for lots of these positions. So they bring an amazing sort of functional set that saves our executives so much time, which is really important.
So you get to that point where you, through the investment, in this instance, Mosaic have a fantastic network of obviously biggest banks in the world, clearly senior people sat on the board, and then you guys are focused on many things you just explained, but one of them is talent, because you sit there and go, right, if we're raising this much money to get to that next round and through that and create a business that at some stage can have a really exciting event, which it needs to be, you need to staff this business up. And so how do you see that as one of the major factors to the success then of that business?
It's perhaps the one piece that is irreplaceable. All you've kind of got is a group of people around a business and around a vision, and their ability to take that vision and bring it to fruition and build it into a huge business is, paramount, right? And I think where we tend to contribute is in terms of helping them think about how to structure talent, how to attract talent. We will very rarely go into the nitty-gritty of you should hire this person, not this person, because we're frankly just not close enough to the action, and the CEO and the C-suite of these businesses are in a much better place than we are. But thinking about, folks that can help the business scale, businesses are very different from when they're seed stage, pre-product, to early revenue, to scaling internationally, right? And getting the right people in at each stage is pretty critical. And our talent function has seen this happen across a wide set of data points and can help our businesses kind of pattern match.
So I just want to now think about this from a founder's perspective. So, it's a tricky road. Not many founders end up potentially where they might want to be. They put, sweat and blood equity in, and then you'll know better than me, but we find that they end up on single digit equity sums of the business that was their vision. They've worked for often a decade, and then could be ousted because firms put in other people into those senior positions. So that's the way of the world, but it's obviously not ideal. This is, I think, something that venture capital has a bad reputation off the back of. And there's a business model in venture capital that some founders therefore choose to stay away from because of the risk of that. So it's not for everybody. And I'm sure you're not trying to be for everybody. It's just to paint the picture. So I suppose a couple of questions from me are, do you think that needs to change, or it's fine how it is?
It's a lot more granular than you might think, right? So I can give you some examples of circumstances. Recently, we've seen a few businesses where the founders have come to us and they have had perhaps single digit or low double digit sort of equity stakes in their businesses. And we find that as alarming as the founders do. We started this conversation with talking about backing the founders who are looking to build these great businesses, well, we want to be fully aligned with them, and a great equity outcome for them is a great equity outcome for us. So if someone comes into a business and they see their equity stake being diluted, you'll often see, and we're certainly not the only fund that will do this, but sort of option top-ups along the way to ensure that folks are properly remunerated. The other piece that I would say, I think, is that the founders that we look to back are ones that are looking for sort of massive change, right, in the industries they're working in. And in order to create massive change, you need leverage. One person basically cannot create massive change on her or his own, no matter how much they want to try. And capital is a really efficient form of leverage, right? This is the old adage: would you rather own 10% of a huge thing or 90% of a sort of slightly smaller thing? There's no right answer to that. The founder has to decide, and if they decide that they want to, leverage themselves through capital to create massive change, then venture capital is a way to help them do that.
What I really want to talk about is what makes you tick, and that, of course, is the future of money. So right now, let's start with what particular trends you're seeing.
Yeah. So I think that the one sort of mega trend that's still playing out will be no surprise to any of your listeners, which is the internet. Right? The internet has changed the way we do so many different things, but the way that it has affected and will continue to affect money is quite peculiar and really fascinating. So some of the key things that are going on within fintech and within sort of everything to do with money are these. So, you kind of have the internet coming along and reducing transaction costs for almost anyone, right? Your ability to get to a customer, serve them digitally, your marginal cost has kind of gone down to zero, your transaction costs have kind of gone down to zero. And what that means is basically what you're seeing in lots of markets at the moment, which is your ability to unbundle certain industries and certain sort of monolithic organizations, right?
What's an example of one?
So you can look at the insurance space, right? Previously, you used to have, well, you still do actually, because it's just getting started. You have these huge insurance businesses that do their own distribution, do their own pricing of the risk. They do their own, well, of course, they have their own balance sheet that they use to underwrite, and they do their own claims management and all that sort of stuff. Because your ability to transact with third parties has gone down so much. In fact, you had a couple of guests who are great examples of this, right? I think you spoke to Hussein from Onfido and recently Andy French from sort of Scalable Capital, that's right. And, their B2B offering is something that means it enables companies to take these functions that historically made the most sense to do internally and outsource them, right? And this actually goes right the way back to Ronald Coe's Nature of the Firm, 1937, right? It's sort of nothing new. Transaction costs define what a bundle looks like and what the sort of frontiers of a firm looks like. And if you can reduce those transaction costs, you see massive unbundling. And that happens in banking that we're seeing at the moment, both on the retail side and the institutional side a little bit, in insurance, in payments, across the sort of the entire gamut, really. The second piece that you get because of the internet is data and pricing. Right, so prices are just a sort of aggregation of all the information, the data that we have about the state of the world, what people want, and our knowledge of how to create stuff out of the resources that exist in the world. And our ability to increase the amount of data that comes from, more sensors being collected through IoT devices, and our ability to transact that data again at zero marginal cost on the internet, means that we're able to price things in a way that we haven't been able to do before. And that's got some serious implications. So Ben Savage at Octopus Ventures, one of our co-investors on the West Coast, has this sort of great explanation of a sort of piece of residential real estate, right, which is a pretty sort of hefty investment for any individual. And if you look at the cap table of that piece of investment, it's pretty simple, right? You kind of got like a bit of equity that's at the bottom, and then most of that is kind of debt. But in reality, if you look at the various asset managers around the world and their appetite for different sort of levels of debt and different amounts of risk, why not sort of slice up that cap table and offer it to different folks who want different levels of risk, and perhaps you can end up with a way for people to live in houses that they would like to live in for a little bit sort of less cost for them personally, right? And that has been enabled and starting to be enabled by better data to value the assets and lower transaction costs so that enables us to actually trade some of these assets. And when more deals can be done, you have more liquidity, and quite often that means you have better, it kind of works in cycles, where you have better pricing because you have more competition for the same assets. And over time, hopefully, costs will come down for everyone. And what that means is that we use the Earth's resources in a better way, right? Yeah. And the third piece I want to touch on, which is a little bit subtler, but it's probably the piece that I'm the most excited by within all of financial services and fintech, is this idea of sort of digital scarcity, right? Which again comes from the internet. So over the last however many decades there's been a shift from what they call kind of regular disintermediated securities to now intermediated securities. So if you imagine back in the day, you had a bond certificate that was totally non-intermediated, right? So you would take that bond certificate, there'd be coupons, physical coupons on the piece of paper, and whoever held those coupons had the rights to the payments from that bond certificate. Now, because of the internet, we want to digitize things. It seems rather silly to hold a piece of paper and sort of pass it around and try to send it around the entire world. But that creates a problem, right? Because the whole purpose of that bond certificate being so difficult to forge is that when you own it, and nobody else owns it. Same thing with a £10 note in your pocket, right? The sort of forgery is such a problem because people are always trying to recreate and duplicate it. And the foundational effect of the internet is that you can now duplicate things like that at zero marginal cost. And whenever you can do that with anything of value, people have tried to, right? You think about sort of pirated MP3s and movies in the beginning of sort of the internet. And that creates a problem, right? Because it means that anything of value, any sort of financial asset that you have in your pocket that you want to transact, all of a sudden, it has to be intermediated. Because otherwise, Lloyd, you can claim you've got it. I can claim, well, actually, that's kind of mine by just doing a simple Control-C, Control-V onto my desktop. And all of a sudden, no one owns anything. So what's developed over the last few decades is, whole swathes of financial services firms who exist to be that intermediary. And it's a very important role to play, right? They say, I have a list of assets on one side and a list of owners on the other side. And I am the one who is a single source of truth here. And importantly, I'm the one who can then summon the power of the law and the state to come and enforce my source of truth.
Yeah. You just can't believe when you look historically at some of the product evolutions that didn't happen immediately because of the fear that it would not work due to fraud or not being able to control your commodity. We use the music industry, for instance. At the infancy, it was a jukebox, wasn't it? Where the jukebox might have 250 songs on it. And of course, everybody's buying physical CDs or whatever it might be. And then you take it forward 10 years. And of course, it's intuitive to pay a subscription fee to a Spotify. And we're all super happy that came around, I think. But, perhaps unless you're an artist, but I think this is going to be resolved next. You're spending an awful lot of your time looking historically at how things have disrupted and then looking into the future. When you're looking 10 years into the future of finance, how do you imagine it to look?
So timing is always very hard with some of this stuff, right? But as we look at, I think, hopefully 10 years, it may take a little bit longer. What we'd love to see is kind of what we think of as safe and efficient transactions happening faster than the speed of thought. Right? Let that sink in for a second, because every sort of piece of that is really important, right? Money has to be safe because it's very important for all of us. And what does that actually mean? That means that, the transactions happening aren't fraudulent. Hopefully they're not regretted. I'm not sort of spending something and then 5 minutes later really, regretting that decision. It means that the efficient transaction piece means that we're talking about low costs, if possible, low transaction costs, and actually also talks to the transaction itself being something that should be happening in the world, right? What's the purpose of money? It's it's a medium of exchange, but what you're always exchanging is the natural resources, some combination of the natural resources of the earth and human sort of ingenuity and human industry, right? And the way that we use our ability to manipulate resources to create stuff, that can have some great effects for humans, and it can have some really deleterious effects for the environment and for the world. So the transactions in and of themselves, we want them to be efficient, both in terms of cost and in terms of them being the right transactions for the world. And faster than speed of thought just means that we can get there kind of now, right? This is amazing sort of anecdote that I forget who tells it, but you can sort of get on a plane with a suitcase full of cash and arrive in Australia before your bank transfer does, right, today. And our ability to solve that is going to be really important. And the final piece for me, and I've sort of spent a lot of time in the crypto world, is this idea of open ecosystems. So money is one of the few things where lack of scarcity breaks it, right? We talked about MP3s earlier. If I've got the latest, Kendrick album, whatever it might be, you can recreate that, and putting to one side the economics of how that sort of works for the production function. It's kind of great that everyone is able to have and enjoy a piece of music like that, right? With money, if you sort of get rid of the scarcity function, it stops working, right? Because all it is a representation of the time that humans have to dedicate to things and the resources we have at our disposal. And those underlying things are not sort of infinite, right? In the way that you can make money infinite. And because we've now created sort of digital scarcity for the first time through distributed ledger technologies and that sort of thing, it means that actually you can open up the environment to folks experimenting with money in a way that you could never do previously. Previously, sort of going back to the ledger sort of example, you need someone who's highly trusted, highly sophisticated to look after a ledger, because it's very important to accurately represent the state of the world. And now we're able to do that in a trusted manner that doesn't need sort of a whole lot of bureaucracy around the organization. And that opens us up to amazing sort of potential innovation within an open ecosystem in which anyone who has an idea is able to start building, experimenting, in the same way that sort of limited liability companies have enabled people to try certain things in business. And sort of being able to code and open protocols on the internet enables folks to create new products that most of them may not work, but for the one or two that do, it can have massive effects on all of us.
If we think over the last 5 years about the cryptocurrency space, or even 10 years ago, a philosophy comes out, and then perhaps over the last 5 years, apart from incredibly niche early adopters, this has been in the media more, and then up to today, it almost feels like it's less in the press right now, versus 2017. But what you're seeing is clearly the continued effort of this sector moving on upwards. Is it to you almost inevitable that over the next 5, 7, 12 years, there will be a move from physical cash, central monetary systems to digital currency?
Inevitable is a really dangerous word, right? Especially when you're sort of on a recorded medium like podcast. So to my mind, what do I think? I think that lots of the incentives that drive adoption of currency or networks or any sort of network effect driven product appear to be there, right? So if you look at the way that let's talk about the original cryptocurrency, right? Bitcoin, that's been around now for more than 10 years. The fact that it's endured for more than 10 years, the fact that I think over the last 10 months or so since the start of 2020, it's increased in value by 50%. If you look at the supply and demand dynamics that exist long-term within that protocol, it suggests that, it's something that will be useful to people and valuable. But a whole host of things may happen between now and 2030 to affect that.
Yeah, so I think with this type of future prediction, for me to try and put questions across to you that are, binary is too hard, because we'll need to spend 10 minutes like philosophizing on.
I mean, you can kind of just ask what's in your portfolio,
Potential.
right?
Yes,
there's the classic like.
What let's talk about that crypto. What is it?
Yeah, sure. So it's a business called Skew, built by a couple of sort of ex traders from the city, and the way that they've built a product, I guess, sort of to provide a little bit of context. So crypto is kind of important today in three areas, and they're relatively distinct. Over time, they may come together. And I'm talking about public ledger crypto here, not sort of the private blockchain side at the moment. And it's important for, sort of crypto itself as an asset class, as money. That's kind of the area that Skew plays in. All right. There's also crypto that fuels DeFi, decentralized finance. There's also crypto that fuels Web3, right, which is kind of like a decentralized internet. And those two things are really exciting, but that's kind of not where Skew is at the moment. Skew enables institutions, so like grown-up regulated institutions, to participate meaningfully within the crypto derivative space. Right. So if you look at the history of capital markets, and if you look at sort of when derivatives came about to help hedge risk and help sort of folks manage, huge upsides or huge downside scenarios, that now has come about in crypto. Some sort of very sort of well-established, high credibility organizations like the Chicago Mercantile Exchange have come into this arena to offer products built on top of sort of underlying crypto assets. And Skew is a business that enables sort of other institutions to participate in that world in a way that is safe and regulated.
When you talk about all this stuff, you come across so incredibly passionate. Of course, let's try and understand where this has come from. So you choose to go to Oxford University and study economics. So even before then, you're into finance, economics. Where did this come from? Where did this passion come from originally?
Yeah, so I was very fortunate in being able to do economics quite early in school. Actually, I did for my GCSEs, which I think is like kind of atypical for most people in this country. And I remember very clearly my first economics lesson, where it was Mr. Bruff, who basically said, economics is the study of what we produce, how we produce it, and for whom we produce it. Right? And that's the foundation of all of this stuff. And why is that important? Well, kind of all we have in the world is a bunch of stuff, and we use it to build a bunch of stuff, right? And that really stuck with me throughout all of these years. And it's where I go back to when I think about, what are we trying to do as a society? And when I think about money and its role within that society, right? For example, something as simple as a pencil, no one person in the world can create that from scratch. If you put anyone on a desert island with sort of all of the resources they might have, no one can, create the right compound for the graphite, chop down the wood, let alone figure out how many pencils might be needed in the world and, how to distribute them properly. And economics and our sort of approach to money helps us do that. In short, it kind of helps us collaborate as a society and build things like, from pencils all the way to iPhones and iPads and, all kinds of wacky things that we have these days.
So Mr. Bruff,
that's right,
inspired this within you, and then you end up at Oxford University studying economics, which is obviously one of the great places to go to do that. Whilst you were there, what type of strategy did you have for your career?
I'd describe it as non-existent, really. So winding back a little bit, my family and I, we immigrated to the UK when I was 5 years old, and from China. And my parents grew up in a very different kind of societal context, right? This was sort of deep communism, as it were, and sort of the way you approach society and actually how you produce things and for whom you produce things was very different to sort of what we know today in sort of what we call the Western world. And as a result, no one we knew had done anything vaguely corporate or financial. My parents were both sort of teaching engineering at sort of the local university in China, and my grandparents were, doing farming and all this kind of stuff. So coming to university, I remember someone said, "Oh, one day we should start a private equity fund," right? One of my colleagues at Merton, who clearly had come from that kind of background, was like, "What's private equity?" So I fell into a spring week at Merrill Lynch, because that's kind of what you did when you did economics or PP or whatever it was that was vaguely related to finance at Oxford. And frankly, I just didn't really get it and didn't really enjoy myself. So during second year, when everyone else was, they'd taken up their internship offers from, Merrill's and Goldman Sachs or whatever it might be, I took a motorcycle around Ghana for 3 weeks, visiting a friend of mine and her family who were there. And coming out, realizing that actually this is a massive detriment to trying to find a first job, because everyone else has an internship and I didn't. I sort of just did the other thing, as it were. If you did economics management at Oxford and you didn't do banking, chances are you're going to go be a consultant. So I went and fell into consulting.
You'd done really well. You were inspired by economics, obviously, but you hadn't maybe been shown the path that some of your colleagues had. And then that means you end up in strategic consulting. And you go there, and it's a period of time where you actually learn to love it, or through that period, you're not as ambitious with your career?
So it's funny you say that. So I sort of see it as having not really seen what a path looks like, right? It was very much, you kind of see kids within the community when you're growing up, and you see them going off to university, and you kind of never see them again, right? And, I grew up in Reading, and from there, folks would go up to London or go up to Oxford and Cambridge, and you would just never see them again. And you just kind of assume that then life happens and everything's like happily ever after. So, going into consulting, I very much fell into it, right? Kind of as you say. And I think that, there's ambition for just doing well at whatever it is you're doing. And then there's ambition for the very specific job that you're in, right? And I certainly think that I had lots of ambition for being able to do work that I was proud of. But after not very long, realized that my ambitions to remain in consulting for the rest of my career were pretty short-lived.
And that in consulting, did that come from being on some financial projects?
Oh, not at all. I did. I was working in heavy industrials, aerospace and defence.
So how do you then get back to this moment where you are now, and the audience could tell this, truly focused on what your passion is, the future of finance?
Yeah. So while I was doing consulting, I sort of fell into Bitcoin, right? So coming out of doing economics management at university, you learn various theories of how the world works, and not many of them made a huge amount of sense to me, which is probably why I ended up with a low 2-1 rather than a better grade. I was kind of thinking about actually how does this actually work, right? I had no idea. And fell into sort of a little bit after university, I suppose, this idea of the Austrian school, right? So I don't know how closely you and your listeners may follow this, but the idea that actually the business cycle is kind of caused by, like credit and sort of credit policy within and monetary policy within sort of government, and this idea of denationalized money, right? Which was pretty mind-blowing to me. I'd only ever known money as the thing in your pocket with the Queen's face on it. And when the Bitcoin white paper, a friend of mine sent it to me in 2012, 13-ish, I think. I just thought, okay, this is absolutely fascinating. And I started following the space, right? So a while later, I had a very small e-commerce business, and I sort of was playing with Bitcoin and integrated BitPay into that, which is a payment processor for e-commerce businesses that can accept Bitcoin. And then, when Ethereum was developed, that was a real trigger point, actually, because it meant that you moved beyond sort of pure currency towards something that, they call Turing complete, which means that you can sort of write any kind of programming on top of a currency. And I sort of just followed that all the way through.
Yeah. And see, at that point, as as the adventurer that you are, what happened? You looked to set one business up, and you did, and then from that experience, you decided you didn't want to keep on persevering to found and create a business in this space.
Yeah, so it was an e-commerce business that frankly was started because I kind of wanted to start something. Yeah. I'd spent time, 1 week at a bank, a few years in consulting. I had a week of work experience in an accounting firm when I was 16, and none of it particularly resonated with me. So I thought, well, actually, for someone who doesn't do very well at jobs, maybe not having a job is a good idea. And the only way you could do that is try to found your own business. So I started, it was very much with the end goal of being a founder and trying to build something, and realizing quite quickly that one, I had neither the skills, and two, probably more importantly, nor the passion for the space, right? After a few years I was part-time at Roland Berger at this point, and part-time trying to build my own business, I sort of figured this is unsustainable. And applied to business school, kind of for a change of scenery, and actually to get a little bit more sort of US exposure as well, which is something that I felt was quite missing in my trajectory to that point in my life. And the way it sort of all shook out was that I got into one of the schools in the US. They sent me the bill. I had thought about it beforehand, but it was all very abstract until it's on a piece of paper with your name on it. And I was trying to desperately think, okay, let's say, my plan A was to go to business school, drop out, become a startup billionaire, the classic sort of absurd plan. And when that bill came through, I was like, okay, what's my plan B going to be, right? If, let's say that doesn't happen on the off chance, what am I going to do to justify the amount that I'll be paying to the school? And one of the partners at Roland Berger at the time said, well, given sort of some experiences, why not venture capital? And I was like, well, what's venture capital? Looked into it and actually thought, if I get to work with founders all the time, get to think about interesting problems at the early stage that really might change the world, that was really appealing to me. So I started meeting a bunch of folks in London, and this was the summer before I was supposed to go off to Wharton, to learn more about the space. Do you think that a sort of, what was it, at this point, 5-year consultant, Wharton MBA grad might have a shot at venture capital? It just so happened that Octopus was hiring, and I managed to wangle myself a job. So I ended up sort of staying here and starting at Octopus in August 2018.
So now if we're back in current time, because we've done some of the Octopus journey and we understand you and what motivates you, you're in a really good position now. You enjoy venture capital. This could be what you spend, your life's work within, unless at some point you found. Who knows when that might happen, or if you'd even want to now. What are you hoping for? Not in terms of portfolio companies or the space anymore, but in your career. What is it that's driving you?
I think fundamentally it's sort of doing work that I both enjoy and that I can be proud of. And it's hard to break that down further, I guess. One of the best things that we get to do in this job is meet founders all day long, founders who are incredibly passionate about what they're trying to build. And that passion is infectious, right? And there's an energy that comes from working with those individuals and those teams that, you kind of really get a buzz out of yourself. In a way that's quite different to, other jobs, well, the very few other jobs that I've had. Right? In consulting, you kind of know the numbers you're aiming for, but there's less of that passion. And that passion is really what's important, I think, in helping me enjoy just the time that I spend and how I spend it.
And what do you do on if we understood a day or a week of your time, what are you doing to be the best venture capitalist possible?
Oh, there's, part of the problem with this job is that firstly, there's so much you can be doing. And secondly, you kind of have no idea if you're any good for a while, right? And that's the trope that you will hear, quite a lot from people in this industry.
Especially if you have this 10-year portfolio.
Exactly. And the journey isn't straight, right? You can look at certain things like, follow-on funding, and you can look at sort of metrics and all that kind of stuff. But until there's a real exit and you've made money for your investors, you don't necessarily know. So all you can sort of try to do is try to peel apart, what I think makes a great venture capitalist, and try to sort of almost ape those things for a while, and until you've got the experience under your belt to get there. Having done this now for just over 4 years, I recognize that it's early in the journey, right? And the experiences that lots of other folks in the ecosystem are going to have are vastly outweigh mine. But to try to get myself up the curve, I try to look at the experience of other companies, look at the experience of other investors. A lot happens in a very short space of time for lots of these businesses. I think if you divide up the journey of an early stage business that might be 10 years, you'll probably get 5, maybe 6 sort of 6-month periods, or even 3-month periods that really have mattered, right, and moved the needle for some of these businesses. And listening to podcasts like yours and others out there really give you a sense for how do people make decisions in those critical times, and how can I sort of take learnings from that, right? So that's sort of one thing. Another piece is actually venture capital itself as a business has evolved and will evolve. So how do we think about the role that we play within the ecosystem, and how we can better serve the entrepreneurs that we're looking to serve? That becomes a big part of it as well, right? You can sort of keep looking backwards at just deal stuff, but as you look forward, the way the franchise will evolve and has evolved in lots of different funds is going to be critical to the success of the careers of the folks sort of contained therein. So I try to spend a bit of time looking ahead as well at sort of what should venture look like in the future as well.
See, thank you so much for coming on the show.
Thank you, Lloyd. Real pleasure.